Hello everybody, it's Yashar here, back again with another video, and in this video I'm going to talk about Alimentation Couche stock. Almost 2 years ago I analyzed this stock in detail and concluded that the stock fair value was around 63 Canadian dollar, which I mentioned in that video that Alimentation Couche stock was undervalued at the time. 2 years later, today, the stock currently sits at around 76 Canadian dollar per share. And in this video, I will update the financial metrics of the company and give you my updated thoughts and the new fair value using my personal discounted cash flow model. And will then provide you with the fair value of this stock depending on your investment goals. The company HQ is located at Laval, Quebec, and their shares are traded on TSX for almost 76 Canadian dollar at the time of recording this video. They pay a dividend with a starting yield of less than 1%, and the market capitalization of the company is around 71 billion Canadian dollar. Alimentation Couche was a growth beast in the last decade, and their performance was absolutely top-notch. The stock recently had a major pullback due to their offer to buy Japanese 7-Eleven convenience stores, which is rejected initially by Japanese 7-Eleven, but Couche management is still in negotiation phase to be able to complete this acquisition. Due to their major uncertainties of this kind of huge acquisition, some investors sold their shares and the stock price took a hit. I think now it's a good time to take a second look at Alimentation Couche and see if the stock offers any significant value at the moment. Couche owns more than 14,000 convenience store and gas stations, including Europe, Asia, Canada, and pretty much every single state in United States. You probably visited at least a few of their locations in your life if you ever traveled around North America and stopped at a gas station under the brand of Circle K or Couche or Ingo. Couche own almost 5% of the fuel and convenience store market shares in United States, which means while Couche is huge, they still have room to expand their business, grow, and take more market share even in United States. Couche brands itself as a recession-resistant company, and their performance during the previous recessions is a proof that this company can actually continue to grow and improve their sales even during the worst economic conditions and recessions. Couche was able to grow their business based on both development of new stores and opening new locations, which we can call it organic growth, and also successful acquisition of various convenience store chains and gas stations in the past. In terms of the financials, Couche was able to grow their adjusted EPS by an average of around 20% year over year in the last 10 years, which is probably an amazing rate of growth for this business. They also had a great growth in the profitability and margins of their business. Their fuel gross profit has been increased by almost 20% year over year in the last 10 years, while their margin on merchandise sales will also grew by almost 10% in the last 10 years. All this growth achieved while they were also able to keep a very healthy level of return on capital employed of around 15%, which is amazing. Especially considering they had a numerous large acquisitions in the last 10 years. Couche has a long history of paying out and increasing its dividend year over year. In the last 10 years, Couche aggressively increased its quarterly dividend with an almost 25% increase year over year, which is amazing fast-paced dividend increases. They also bought back shares between 1 to 5%, which means the management of the company is focused on returning value to shareholders more and more. I also like the fact that the dividend payout ratio is very low. It's less than 20%, which means they have huge room to increase this dividend in the coming years. Now, let's use the updated financial information from the recent earnings report of Couche and plug them into my new discounted cash flow calculator and find the fair value of the stock. To start building the model, I imported a series of general parameters from Couche earnings report like the current share price, their revenue, their number of shares, their net debt, which is their short-term and long-term liabilities minus their cash and cash equivalents, and their net income per share. I also put my expected rate of return to be 10% for this stock, as Couche is a pretty safe business, so I'm fine with only 10% return with such a low-risk company. Now, in this model, I will calculate the fair value of the stock by projecting their future earnings and then discount the terminal value and future cash flows minus the liabilities of the company back into the present value of the stock based on 3 different scenarios. In the bear case, or the most negative case for the stock, the business will have a little bit of margin compression. I consider the business to not have any share dilution, and for now, I didn't basically consider 7-Eleven deal to go through. And finally, I consider the business to be able to grow the revenue by only 2% in the short term, 6% in the midterm, and eventually by 10% in the long term. I am considered a terminal multiple of 14, which is in agreement with historical bear periods for this stock. The slow growth at the start is due to the current financial environment, which is driven by high interest rates, and as eventually rates drops, we can expect the growth to come back for Couche. For the base case or normal case, I considered a little bit better margins in line with their historical average, a little bit better revenue growth, and a terminal multiple of 18, which is historically an average multiple for a similar stock. Finally, in the bull case or the best possible outcome, I considered a little bit better profit or a bit of profit margin expansion, an 8% short-term, 14% midterm, and 16% long-term growth, and a terminal multiple of 22, which is a bull multiple for the company. Now, if I hit calculate, the software will give me some valuable information about this stock based on my assumptions. It gives you the intrinsic value of the stock in each scenario, and then it will provide you with a fair value estimate, which is around 72 Canadian dollar per share for Alimentation Couche, and comparing to the current share price, Couche trades at around 5% premium today. It is basically traded at its fair value, so not a strong buy, but for such a high quality stock, I would consider buying it even at the fair value. It's always fun to see what analyst predictions are for a company, and according to National Bank analysts, the price target for this company is currently at around $85 per share with a sector perform rating. It seems National Bank analysts are much more optimistic about Couche than me, but it all depends on your expected rate of return and your assumptions, which for me are a little bit more conservative. In summary, Couche is a great business with recession-resistant earnings and excellent growth history in the last decade, with a management team which is focused on return value to shareholders via dividend and share buybacks. The stock basically trades at its fair value today, so it is not a strong buy, but you can consider adding this stock to your portfolio for that recession-resistant earnings. I hope you enjoyed the video, and if you enjoyed the video, consider subscribing to the channel to see similar stock analysis videos. Thank you for watching, and I see you guys in the next video. Farewell.